Welcome to the Stockout. This is your show at FreightWaves for all things related to the CPG industries and the retail industries. I'm your host, Mike Bowdendistel. Hope everyone had a good time last night. It was really a great Super Bowl. So if you're coming out and getting your week started, what I have for you today is I'm going to talk through Amazon. I'll give a little bit of an update on the FTC lawsuit. I'll talk through a little bit about CPG companies, why they're unconcerned about the GLP drugs. I'll talk about the cocoa prices hitting new all-time highs and what that means for the likes of Hershey's, Mondelez, et cetera. And then I'll talk a little bit about a white paper that my colleagues at FreightWaves wrote on the freight industry called Asleep at the Wheel, why they're maybe expecting potentially the freight market to turn later this year. So I'll talk through some of those highlights. I think that was a good report. But before I do those things, I want to make sure everyone has a chance to sign up for the Stockout newsletter, which you can sign up for at www.freightwaves.com/the Stockout, or just go to the site and go up at the top under newsletters, under supply chains. That's going to be the first one listed there. Try to get one of these newsletters out every week. Try to include some commentary on the freight market in addition to what's happening broadly in the retail and CPG industries. Try to talk about sort of the implications for other companies if it's one sort of specific news story to one sector or one company, what it means for others. So try to make it relevant to a broad group when I publish that every week. So with that, I want to talk through our first topic, which is to provide an update on the Amazon FTC lawsuit. If you haven't been following this, I think it's really interesting. So this was a lawsuit that the Federal Trade Commission and 17 state attorney generals brought against Amazon in September. This was, there it is, September 23rd. And so they're alleging that Amazon is abusing its monopoly position. And it's doing this in a number of different ways that are all reinforcing on each other. So for instance, that Amazon's harming consumers by the fact that they have all these web crawlers that look at other websites to see if those websites have products that are being sold below what is being sold on Amazon. So it does not pertain to companies that are selling them directly for like a direct-to-consumer site, but it would pertain to another superstore or a Kroger. So if a company is selling less someplace else than they are selling on Amazon, potentially Amazon is punishing those sellers on the Amazon marketplace by having being lower on the search results. So they're doing those things. There's a question of whether Amazon is being fair in having higher search results for companies that are buying advertising space. There's also a question of whether or not Amazon is being fair to Amazon marketplace sellers by requiring them to use Amazon fulfillment centers in order to qualify for Amazon Prime, designation, which is really critical because Amazon Prime members buy about 4 times as much than non-Amazon Prime members, about $2,000 versus about $500. So it's really critical to have that Amazon Prime designation. And there's about 167 million people in the United States that have Amazon Prime. So it is most people at this point. And then there was also this Project Nessie, which Amazon says is not relevant because they've gotten out of it. But essentially Project Nessie was looking at elasticities to see if they were to raise prices on Amazon, if other websites would follow suit and raise their prices, or would they keep them the same and those sellers end up being potentially punished in the search results on Amazon. So all those things FTC alleges Amazon's doing. They say that it's anti-consumer. They say all those things are reinforcing each other. And they've built out this monopoly essentially with Amazon representing about 38 or 40% of online e-commerce. And so that's sort of the background. The update is Amazon asked a federal judge to dismiss the case in December, so that Amazon says that this has actually lowered prices for consumers. The fact that they're in the marketplace is a benefit to consumers. They pointed out that the precedent does not seek to punish behaviors that actually benefit consumers. So, a lot of the stuff that, going through the FTC lawsuit, the impression that I got is that it's very difficult for third-party sellers to be profitable on Amazon. But I don't get the impression that consumers necessarily getting worse prices on Amazon, or if they are, maybe they're paying for that convenience and maybe paying a little bit of premium, knowing that they're getting their products more quickly, and really sort of paying for that convenience, and for that reason maybe it is to the benefit of consumers, as Amazon says. So Amazon also says that these practices are common in retail industry that the FTC was lining out. They said Project Nessie was not being used. So that's really not relevant, and so it's not exactly clear what the FTC is seeking. It's only clear what FTC thinks Amazon is doing wrong. But Amazon says that any potential changes could fundamentally alter Amazon's business. We can only sort of speculate what some of those changes are, maybe unwinding some of those things I just described, some of those practices that Amazon's doing, maybe a Chinese wall between the advertising and the search results, something of that nature. But one thing that's interesting is Amazon is asking the FTC to depose only 10 Amazon witnesses, whereas the FTC wants to depose over 100 people. So they're really not on the same page there. And then what also strikes me is the scale of just how much information. So it's 100 terabytes of information in the discovery process, equivalent to 50 million pages. And so Amazon's expecting expects the depositions to begin in June. FTC has asked the court to set a deadline to be ready for the trial by May 2026. Amazon asked it to be pushed back to December of 2026. So this is going to be with us for some time. And it's my perception on this is that if Amazon's taking advantage of anyone, maybe it is those third-party sellers, not so much the consumers. The sort of whole, I think the FTC's argument is that if the consumer is really being taken advantage of by Amazon, the consumer doesn't know about it based on their behavior. I mean, 91% satisfaction rate for Amazon Prime, and most U.S. households have Amazon Prime, happily pay the $139. So if consumers, are really being taken advantage of by Amazon, they don't seem to be showing it by shopping, elsewhere. So it'll be very interesting to watch. There is a good article by the Seattle Times, which I got some of those updates, from on sort of the latest in terms of the timeline. So I encourage people to check that out. So with that, I want to go into the next topic here, which is the CPG companies seem to expect very little impact from the GLP drugs, Ozempic, and the like. It was a pretty significant bear thesis last year, was that GLP drugs would reduce people's consumption. They seem to impact people's cravings, just overall, consumption levels, make people just full and not grabbing for another snack. But there are a couple of interesting, comments from CPG executives. A couple of these were from CNBC articles. Hershey's CEO Michelle Buck said the impact of GLP drugs, really not seeing an impact from that, and don't expect a material impact in 2024. Mondelez's CEO said something similar. So Mondelez is the company that owns Oreo cookies, many chocolate brands, many sort of snacking brands. They said that they sort of quantified, and they said for the next 10 years, if 5 to 10% of the population is on that drug, that's potentially a reduction in calories of 1 to 1.5%. So they wouldn't be concerned about a 1 to 1.5% reduction in total calories. They say that's kind of in line with their range of errors anyway when they project how much their sales are going to be, or their volume is going to be. The counter argument to that maybe is that these GLP drugs cause such a reduction in strength and muscle that if you were going to be on them, you think that you would be really pounding the protein, and that a calorie is not a calorie is not a calorie, and you would cut back on unnecessary junk food more than you would cut back on other things. So maybe it would be more than a reduction of 1.5% on the types of products that a snacking company would offer. But in any event, I do think that GLP bear thesis did get to be a little overblown last year. A couple other interesting tidbits here from Hershey's, and I'll get into this with the cocoa discussion, is they expect their gross margins to fall about 200 basis points, really because the input costs are still rising. Mondelez said that the M&A valuation targets have gone up, kind of despite the higher interest rates. So I don't know. It didn't sound to me like Mondelez is going to have another big blockbuster acquisition here, like they had with Cliff Bar, here recently. So Mondelez said that they're going to take price increases in chocolate, more so than the other types of snacking brands. And that gets into the next topic, which really explains why that is that the cocoa prices have really gone crazy. And so this is a chart, and it's really almost going parabolic at this point. So this is a cocoa chart. So this is from barchart.com. This goes all the way back to 1980. And so this broke through the all-time record in 1977 for cocoa prices, and they've roughly, more than doubled this year. It went from $2,500 a metric ton to $58.86 per metric ton. Barron's know the Hershey's could face a 30 to 90% increase in cocoa costs depending on their inventory and forward coverage. And so that's part of the reason why Hershey's, even though they're expecting a 2 or 3% sales growth this year, they're expecting roughly flat to down earnings and profitability. They said that they're expecting gross margin contraction about 200 basis points. So it does take a little bit of time for these CPG companies to catch up. Their costs move faster than their on-shelf prices. And the reason those cocoa prices are surging to the extent that they are, it really has to do with growing conditions in West Africa. Most of the cocoa is farmed in West Africa. There's been decimated, crops have been decimated by adverse weather, massive rains, massive dry spell, coupled with wind. So just really harsh growing conditions have given rise to pests and disease of some of these crops. So just really tight on the supply. And so what some of the analysts are saying as well, it's you think of chocolate as being Valentine's Day. Yes, this is happening right in time for Valentine's Day, but it takes a while for those costs to seep through into the prices. So maybe it's going to have a bigger impact maybe on Easter, or even a bigger impact on Halloween chocolates. But significant impact there for Hershey's and Mondelez. It was interesting that Mondelez said that their business is split between chocolates and various other snacks, and they said that the price are going to have to increase more on the chocolates. So that's a pretty good explanation why. There's also the issue that sugar prices are still at a very elevated level, even if the worst are behind us. So this is a 10-year chart of sugar prices, and you see it's really higher than it has been most of the past 10 years. It did peak out in November, so we might be past the worst of it, really for a similar reason, just difficult growing conditions, this time in India, where a lot of the sugar is found. Similar issue, just difficulty with wet conditions. Saw this Barron's article speculated that they were sort of past the worst of those things, but those are also part of the reason why a lot of the CPG companies last year were saying, even though inflation's coming down, even though the retailers would like to see lower CPG prices, a lot of the CPG companies were saying that their costs were still rising for some of the ingredients they were using. The sugar tends to be a big bulking agent in a lot of these CPG items for snacking. It's kind of used as a bulking agent. Part of the reason why the processed foods should limit your amount of processed food. So thought all those things were very interesting. Also want to talk here about a white paper that was just published by my colleagues at FreightWaves, and we have an exhibit on that. So they called that "Asleep at the Wheel: Shippers and Freight Market Outlook for 2024." And so this can be found on the Sonar White Papers website. So you go to sonar.freightwaves.com/white papers, and you should be able to find it and download it. And what they did with this one is they surveyed 79 shippers last month, and they did this they wanted to do it after they conducted their 2023-2024 bid season. Some of the companies may not be fully through the bid season, and this is what they expected. And so basically what you're expecting for contract rates for 2024 versus 2023. There is some difference of opinion there, where if you look at sort of the kind of like a bell-shaped curve there, 27% are expecting flat. Some are expecting the rates to be a little bit lower. Some of the CPG companies I've talked to are in that highest one there with the 10% or lower or more, at least on the intermodal side. Some of those are from what I've heard, are down double digits. And so, but it is a little bit of a mix based on what is being moved. But for the most part, let's call it down mid-single digits. And the other thing that the research team found is that the shippers awarded positions in the routing guide to slightly fewer carriers, so just more of a focus on the core carriers. And there is some strategic rationale behind that. Is you take care of your core customers when the freight market's weak. Maybe they take care of you when the market turns. They're bring up the case that maybe there's some degree of risk there, just because the non-asset base have maybe a little bit more optionality. So it's I think that's been part of why you've seen job cuts at a lot of these non-asset based companies. A lot of the brokers really have cut a lot of people here recently. The asset based carriers have done a little bit better. Those are sort of the preferred carriers for CPGs, retail companies, when the market's been weak, and it's been weak now for almost 2 years, which is longer than you would typically see in a freight market cycle. You think of a freight market cycle in terms of a trough, maybe lasting 12 to 18 months, and in few months we're going to be coming up on the 2-year mark. So it is a little bit longer. I think the reason it was longer was just the massive amount of capacity that came into the market during the pandemic, chasing high rates that were in the marketplace during the pandemic. So all those things I think are leading to the shippers using the asset-based carriers a little bit more heavily. So another thing that was interesting from that report was on the inventory side. And so they asked the shippers what they felt about inventory. And 44% of them thought they were on target. 31% said they were above target. 18% said they were below target. So there's some mix there. When you sort of look at the inventory to sales ratios, those have come down quite a lot. I think that's part of the reason why you're seeing imports at a fairly high level. So the imports being higher than domestic freight demand is the replenishment of some of those inventory levels. What's interesting is we met with a sonar client recently that does a lot of importing, and what they said is before the pandemic they would look at what the National Retail Federation would say about retail sales, and they would know exactly what to expect in terms of imports, because they were always kind of right in line with each other. But during the pandemic, the inventory has always been sort of too high or too low, and there's been this disconnect where the retail sales are doing one thing, inventory levels are doing another thing, and right now imports performing better than the the retail sales, and part of that seems to be right now a lot of companies starting to replenish inventory. That white paper also goes into talk about some of the sonar charts. It goes into cyclical shift potentially for later this year, where capacity is coming down. You see that in carrier authorizations. You see that in total transportation employment. So there's evidence that capacity is coming out of the transportation network, and at the same time, there is evidence that freight demand is growing. I think if there was a big consumer retrenchment because of the inflationary pressures, would have happened by now, not with employment still strong, not with the stock market hitting new highs. S&P 500 keeps hitting new highs. So I think that the consumer is actually in a decent place, despite some of those metrics you see, like very high credit card balances. And I think that the shippers, based on what those surveys data shows, the shippers are generally aware that the cyclical trough in the freight market are behind them. Very few are attempting sort of really aggressive rate reductions in 2024 versus 2023. I think they've been a little bit more modest, at least on the truckload side. I've seen on the intermodal side those rate reductions be more significant. So the reason they titled that asleep at the wheel, I think it pertains to shippers, that the shippers may be unprepared for volatility this year. They've reduced the number of transportation carriers in their routing guides. So there's potentially, if the market turns, and it can turn quickly, you could have busted routing guides just because you have fewer transportation providers in those routing guides. There was also a good article over the weekend that Zach Strickland wrote, who's the head of market intelligence here at FreightWaves. And he talked, it was along similar lines, where he showed carrier authorizations with capacity coming out of the marketplace while demand is growing. And Zach gives some ideas to hedge against freight market volatility. And those include carrier and route guide diversification, which is important, private fleet growth, which is something that you do see, some of the big shippers, and increasing dedicated service. That's something you certainly see from some of the big shippers, and then dynamic pricing moves with the market. So that's something like a cost plus agreement, something like an index linked contract. I mean, I think a lot of those, take a sophisticated shipper to do that in a little bit more of an innovative approach. They're not real, commonplace. There was actually a question on that in the white paper of whether they were using index linked contracts, and most shippers were not using those type of things. So those are all strategies that could cost the shippers more in the near term, but could hedge against budget destroying events like having to move too much of the freight spend into the spot markets, which is what a lot of the shippers have indicated on the surveys that came back to us, is really didn't have a plan to use certain other carriers. It was really, some of this was just going to fall to the spot market. So all those things are interesting. Encourage people to go check out that white paper. And so encourage you to do that. And some of the other topics that like to speak about going forward, that I'm doing some work on, that I find interesting in the retail space. A lot on AI. So this question of how AI is going to impact inventory management, I think, is a really interesting issue. It seems like the retailers and CPG companies using AI to better predict inventory levels and where their goods should move, using a wider range of variables than they have used in the past. So that's something I'll try to get some guests to speak about that. I think a hot topic sort of along similar lines I've been speaking about here has been how should shippers position themselves to protect against a potential turn in the freight market coming later this year. Have some guests lined up in the coming months that have some thoughts on that. How to exactly to do that, and in some cases it's maybe just not having contract rates where you push them down to as low as you could possibly push them down, and take care of those carriers during the down market, so they'll take care of you during the up market. Some of these other topics are the pandemic era trends, such as supply chain resilience, just in time, just in case inventory, multiple sources of suppliers, diversifying ports of entry. In some cases I've seen companies add distribution centers in more locations closer to the consumers. And some of that is just for convenience to get those products, to the consumers quickly. But, the question is, are those really worth the cost? I think some, people we're going to have some ideas on that. And then where we stand with warehousing space right now and capacity right now. And it seemed like now there's enough warehousing capacity just because there's been, inventory levels have been brought down to a reasonable level. And we'll get more detail on that. And then, I think the Kroger Albertsons transaction is very interesting. They seem to be approaching the CPGs as one united company. It does seem to me like that transaction is going to close, maybe with some more divestitures, although they did make a big move to divest about 413 stores. And then another interesting topic is all these ultra processed foods. Are they really kind of the boogeyman that they're made out to be? I think that's a bigger risk to the CPG companies, just people going away from ultra processed foods than anything related to the GLP drugs. Because I think people recognize that the ultra processed foods have sort of a lot of sugar, a lot of ingredients that aren't natural, and I think CPG companies potentially could add SKUs to highlight how some of them are not ultra processed, which right now I think there's lots of ingredients that just, if they're difficult to pronounce, they're probably not found in nature. So those are all topics that you want to hit on in coming episodes of the Stockout. I think there's a lot related to the technology side as well. Just saw over the weekend that Walmart is going to start to have drone service in DFW area, planning to roll that out. So haven't seen any yet here in Dallas, but keeping my eyes open. And then Aldi starting to experiment with technology similar to what Amazon has. We can go into the store and just walk right out. So I've seen that in sports stadiums to get people in and out quickly for the concessions. So all those things I think are interesting. You have Walmart with the scan and go. So all these companies seem to be leaning into convenience as much as anything else. So try to hit on all those topics on the Stockouts. And with that, if anyone needs anything from me, I can be found at mbowdendistal@freightwaves.com. And I hope everyone has a good day.